So around November of every year, I use my financial independence investment and tax checklist to make sure my money is properly allocated to each investment vehicle. And I also have a cash allocation strategy to make sure I have cash set aside with a purpose. And every dollar to my name has a purpose. And I'm gonna share the checklist I go through to ensure I have everything in order.
Sir, you're out of order. Out of order? I show you out of order.
So the first thing I'm gonna do is review every retirement account I own. And you might own a retirement account or a combination of multiple retirement accounts like 401k, 403b, TSP, or 457. And I'm gonna go over my Roth IRA and HSA in a little bit. And the maximum contribution limit for the employer-sponsored retirement account is $22,500 if you're under the age of 50. And if you're over the age of 50, then you get an extra $7,500 in catch-up contribution, or a total of $30,000. And keep in mind that the 2023 contribution will end on December 31st, 2023. So if your paycheck is on December 22nd or 29th, then that could be the last time you can contribute to your 401k under the 2023 tax year. And this is different from the Roth IRA and HSA, so I will go over that in the next segment. So take a look at your pay stub for the year-to-date contribution. And if it says $20,000, then that means you have $2,500 remaining to contribute up to the maximum. And if you have 4 paychecks remaining in 2023, then that's $625 that you'll need to contribute for the next 4 paychecks in order to max out the 401k. And this rule applies to your 403b, TSP, or 457. But if you don't have the budget to max out your 401k just yet, that's okay. You should at least contribute enough to get your full employer match if you have one. For example, if your employer dictates that you contribute 5% in order to get the 100% employer match, then the minimum you should contribute is 5% of your gross income to get the free money. You should never leave free money on the table. And if you're not maxing out your 401k yet, then try increasing your contribution by 1 or 2%, because that 2% could make a big difference in the long run. And you can download my 401k calculator for absolutely free by visiting firestation.com/resources. And the next retirement account I'm gonna review is my health savings account, or HSA. And this is not the same as the FSA or flexible spending account. And this is the health savings account where I can save and invest every single dollar. My wife and I are on our HSA family plan in tax year 2023, and we can contribute up to $7,750 total to our HSA. And you can contribute up to $3,850 if you're a single individual. And what's nice about the HSA is that our high deductible health plan comes with an employer match. But keep in mind that every employer match will count towards the total contribution limit. It's not the same as the 401k, where the employer match doesn't count towards your personal contribution limit, right? So for 2023, we're getting about $2,000 in employer match. So we just needed to personally contribute $5,750. And we knew this beforehand because it was on the healthcare plan when we read it at the beginning of 2023. And since we get paid bi-weekly, we contributed about $221 every 2 weeks directly from our paychecks to our HSA. So if I multiply $221 by 26 paychecks, that's about $5,746. And if I add that with a $2,000 employer match, then that's $7,746. To max out the HSA, I just simply transfer $4 from my checking account to the HSA at the end of the calendar year. And I have to be careful with the HSA because the tax penalty for excessive contributions is 6%. But also keep in mind that the HSA contribution limit, or the period, is different from the 401k. The 2023 contribution period is actually from January 1st, 2023 until the tax deadline on April 15, 2024. So if you need some time to max out your HSA contribution, you have until April 15th, 2024 to either get to $3,850 as a single individual or $7,750 for a family plan. And the HSA has quadruple tax advantages. So we're always going to put HSA as the second priority behind the 401k employer match. And for the tax year 2024, the HSA contribution limit for single individuals is going up to $4,150 and $8,300 for family coverage. If you're over the age of 55 and older, you can contribute an additional $1,000 as a catch-up contribution. And if you want to learn more about the HSA, you can check out this HSA full tutorial video on my YouTube channel playlist. And the next retirement account I'm going to review is my traditional IRA and Roth IRA. And my wife and I each contribute up to $6,500 to our IRAs, or a total of $13,000 for the tax year 2023. And she has her traditional IRA and Roth IRA with Fidelity, and I have mine with Chase Private Client. It's not that we don't like to combine our finances, but the IRS actually dictates that we maintain our investment accounts completely separate from one another. And the reason why we have both traditional and Roth IRA is that we do a backdoor Roth conversion every year due to our income. So we have to contribute to our traditional IRA as a non-deductible contribution and then convert it to a Roth IRA as a backdoor conversion. And throughout 2023, my wife and I each schedule an automatic contribution of $250 every 2 weeks to our traditional IRA, and that $250 every 2 weeks just sits in the money market fund and is not invested in any mutual funds, ETFs, or other securities. They just sit in the money market fund that pays about 4.75% in high dividend yield. The reason why, so that I can make a lump sum conversion in January of every year. So in January 2024, when I make that $6,500 Roth conversion in January, it's going to sit in my money market fund. And then inside my Roth IRA from there, I just schedule an automatic investment schedule inside my Roth IRA in the amount of $125 every week directly to an index fund. So I only want to invest inside the Roth IRA and not in the traditional IRA. And when January hits again in 2025, 2026, I can do another lump sum conversion from my traditional IRA to my Roth IRA, because I'll have at least $6,500 plus the 4.75% interest I earn from the money market fund. And the only thing I have to keep in mind is that I'll have to pay the income tax for the 4.75% earnings and interest. So unless the IRA contribution limit increases next year, this is a repeating cycle that's pretty much automated. But if you're someone under the Roth IRA income limits, you can just directly contribute to the Roth IRA from your checking account and not have to worry about having a traditional IRA to do the backdoor conversion. You have until the April 15, 2024 tax deadline to max out the $6,500 Roth IRA contribution limit. If you're over the age of 50, you have an extra $1,000 in catch-up contributions with a total of $7,500 by the tax deadline. So starting on January 1st, 2024, you can contribute to your Roth IRA for both tax year 2023 and tax year 2024. After the tax deadline on April 15th, you can't contribute to the 2023 Roth IRA anymore. I've been maxing out my Roth IRA contribution every single year since 2016, and I don't ever plan to miss another one. And having a Roth IRA allows me to enjoy tax-free growth and tax-free withdrawals going into my 60s. And this is my long-term tax-free cash flow for the rest of my life. The next thing I'm gonna review is my investments inside my retirement accounts. Let me first go over my 401k. And every broker should tell you how much of your 401k is invested in stocks, bonds, or cash. And how you diversify your investments is completely up to your age and risk tolerance. And I'm not going to tell you what to do because I don't know anything about your finances. And I'm not your personal financial advisor. For my 401k, I want to make sure that I stick to my allocation strategy that I set based on my age and my risk tolerance. The end of every calendar year is the best time for me to rebalance my portfolio. If one of my mutual funds made more in return and the other one underperformed, this is where I might need to reallocate, right? And it just really depends on what area it's underperforming. If I want to maintain 80% US stocks and 20% international stocks, but my 401k allocation is at 78% and 22%, then I might choose to change the allocation back to 80 and 20. Again, this is not in any form of personalized financial advice to you. And the other thing I would check is how much I am paying in management expenses. Every 401k plan comes with a fee ranging between 0.5% and 2%. And I think Vanguard charges around 1%, and that's pretty much the industrial average. And if I remember correctly, so if I have $50,000 in my 401k that charges me 1% annually, then that's $500 they're gonna take out of my account. So if my investments make 9% in 2023, then my net profit is 8%. If the mutual fund I invest in charges an additional 0.5% in expense ratio, then my true net profit would be 7.5%. And you're gonna find a specific section of your 401k website where it says unrealized or realized gains, and it should tell you both your gross and net profit returns for the year. And when you click on history and transactions, it should tell you how much of your account was taken out for management expenses. And for my Roth IRA and HSA investments, since they're all self-managed, I just make sure that I don't have too much weight in one stock more than the other. And I have index mutual funds, index ETFs, and individual stocks in both Roth IRA and HSA. And again, how I invest my money may not be suitable for you. And this is just what I do to maximize my growth after maxing out my contributions. And my wife and I make sure that we don't just look at the allocation of one investment vehicle. Instead, we look at our entire investment portfolio. For example, I only invest in the S&P 500 index fund inside my HSA because that's all my HSA offers for low-cost index funds. So having that in mind, we don't want to invest all of our money inside the Roth IRA into the S&P 500 index fund. We diversify it with other index funds that concentrate on different sectors. Maybe we want to focus more on stocks that pay higher dividends every year. Maybe we want to focus on a specific sector of the stock market by investing in the sector ETFs. We also don't want to be too heavy in sector ETFs or say mutual funds because those are considered high risk and high reward investments. These are the things we want to keep in mind when it comes to the reallocation strategy. And if you have an old 401k, now is a great time to roll that over to your current employer plan. And if you simply do the rollover, you're not gonna owe any taxes. And it's like making a transfer from one investment account to another. And if you have a traditional 401k account, then transfer it to your current traditional 401k. And if you have a Roth 401k, then you can either transfer it to your current Roth 401k or your Roth IRA. Just keep in mind that once you move money from your Roth 401k to your Roth IRA, you can't move that money back to your Roth 401k. Some people don't move it to their Roth IRA because they don't want to lose the ability to make the withdrawal at the age of 55. And if you choose to do any conversions, and that means converting your pre-tax money from your 401k to a Roth 401k or Roth IRA, then keep in mind that you'll have to pay income tax for the conversion. For example, let's say you convert $10,000. And your marginal tax rate is at 24%, then that's $2,400 that you will owe in income tax when the tax deadline comes due on April 15, 2024. You have to understand differences between rollover and conversions before you make any decisions. And if you're interested in joining my private client program, you can schedule a free one-on-one consultation with me for 20 minutes so that we can get to know each other by visiting firesession.com/coaching. And the next thing I want to work on is my taxes. Around October or November every year, I schedule a meeting with my CPA to make sure that I am not over contributing or under contributing my federal income tax. I'm in the state of Nevada, so I don't have to worry about my state income tax. As a business owner, I have to make sure I have enough money set aside in cash to pay taxes every year. So the first one I'm going to talk to them about is how much I owe in federal income tax by November. I still have until December to have the final number, but I already have an idea of how much money I'll bring in for the months of November and December. So I want to make sure that we have enough cash reserve to pay Uncle Sam when we file our taxes in February and March. Paying a trusted CPA is worth every penny. And I would rather pay $1,000 to a CPA than get in trouble with the IRS. That's just as simple as that. And I like to maintain the 24% marginal tax rate, if at all possible. If my CPA tells me that I'm on the edge of the 32% marginal tax rate, then I would consider reallocating some of my 401k contribution from Roth to traditional. Not all of it, but maybe half of my contribution could go to pre-tax, and the other half goes to Roth. It just really depends on my income so far in November. You should know your marginal tax rate before going with either traditional 401k or Roth 401k. And obviously, what I'm talking about right now is about my case, and I don't know anything about your finances. But feel free to drop some questions in the comment section down below. And the other way we could save money on taxes is tax loss harvesting. We can't tax loss harvest our retirement accounts because they're tax deferred. So we're going to have to look at our taxable brokerage accounts that might have some capital losses. And I know that my dividend portfolio has suffered more losses in 2023, but I can only claim my losses up to $3,000 in any given tax year. After $3,000, I'll have to roll that over to my next tax year. But that $3,000 could be a difference maker if I'm right on the edge of the 32% marginal tax rate. And if I decide to sell any stocks, ETFs, or mutual funds with capital gains, I can sell funds that have lost value to offset taxes on profit from sales of those that have gained value. So if I sold stock A with a profit of $1,000 and I sell stock B with a loss of $1,000, then I can offset capital gains with capital losses for the tax year. This is a conversation you should have with your accountant before selling any investments. And here's some other things you should consider if they apply to you. You should know your filing status in 2023. You'd be surprised to know how many people don't know. And whether you're a single filer, head of household, married filing jointly, or married filing separately, each status comes with different tax brackets, standard deductions, and certain tax credits. Speaking of standard deductions, you need to decide whether standard deductions or itemized deductions is right for you. Most people take the standard deduction because it's so high under the Tax Cuts and Jobs Act. Your CPA should be able to answer that question more accurately. And it's not too soon to start planning for the 2024 tax year. You might be getting married or divorced next year and putting you in a different tax bracket. You might be getting a big pay raise or a fat bonus in 2024 that you didn't really account for in 2023. If you're getting a big tax refund, that's not necessarily a good thing. If you're gonna owe a bunch of taxes, that's also not a good thing. You wanna make sure that your tax withholdings are balanced. And I wanna have $0 owed or returned from the IRS as much as possible. Some of you watching this may rely on the tax return to pay off debt or buy something fancy. Don't do that. You're basically giving the government an interest-free loan when you could have earned more in your paycheck and saved it in a high-yield savings account, making you 4.5% in APY. So make sure to update your federal tax withholdings with your employer. This is especially important for married couples with multiple jobs. Remember that the IRS will penalize you for under contributing to the tax withholding by 90%. Be sure to talk to your CPA if you haven't done it already. And lastly, this is the best time for you to review my financial independence checklist, which you can download for absolutely free by visiting firesature.com/resources. I started my Fat Fire journey in 2016, and I began with calculating my FIRE number. And based on my current expenses and future inflation rates, my FIRE number is $3.33 million invested and $370,000 set aside in cash, which is a total of $3.7 million. And the next step is to make sure I had my rainy day fund, but only up to the total deductibles I have for my insurance. If I ever get into a car accident, that's $500 in deductible. If I ever have to go to an ER for any medical reasons, that's another $500 in copay, maybe. If my house experiences any damages, like the water damage that I had last year, that could be another $1,000 in deductible. So in my case, it was like around $2,000 in my rainy day fund. I still have $2,000 set aside in my high yield savings account, right? And you could be someone who just needs $1,000 set aside or maybe $1,500. My rule of thumb is that your rainy day fund should not exceed 1 month of your total essential expenses. And the next step is to contribute to your retirement, but only up to the employer match. You should never leave free money on the table, right? And because the next step is to pay off your high interest debt besides your mortgage as quickly as possible. And I did this when I was on my debt-free journey between 2014 and 2016 when I paid off over $110,000 in consumer debt. And it's hard to believe that it's been over 10 years ago now. And I'll tell you that it would be impossible for me to get to step 7 right now if I didn't pay off my debt back in the days. You'll never hear people say that they regret paying off their debt, right? And after I paid off my debt in 2016, I spent another 6 months to pile up my cash reserve only to my emergency fund. And this is more than what I did in step 2, because this is my short-term insurance plan to make sure that I have enough cash reserve in case I lose my job, or if I'm not able to work for a long period of time due to physical or mental health. The basic rule of thumb I teach is that if you're in a dual income family where your spouse can cover the expenses while you're unemployed, then have a minimum of 3 months of expenses saved in your emergency fund. However, if you're in a single income household, then you should save at least 6 months of your expenses completely set aside in your emergency fund. And don't keep your entertainment fund, travel fund, and emergency fund combined. They need to be completely separate from one another. And after I maxed out my emergency fund, I moved on to maxing out my Roth IRA and HSA. And then after that, I started maxing out my 401k contribution. I didn't start maxing out my 401k until 2017. It wasn't just the employee contribution. I maxed out the after-tax contribution when I worked in the private sector back in the days. And now I'm currently sitting on steps 8 and 9 of my FIRE checklist, saving about 60% of my income and building generational wealth. And once I'm in my 50s, and I'm 37 right now, once I get to my 50s, this is when I become more risk averse by start paying off my mortgage. I am fine with having a mortgage right now while I'm in my 30s and 40s so that I can continue to invest the difference in the stock market. But once I'm in my 50s, then I want to significantly reduce my liabilities so that I don't have any liabilities like mortgage debt going into my retirement. So between now until I turn 50 years old, I want to maximize my investments as much as I can while paying the minimum to my mortgage. Once I turn 50 years old, I'm going to have a plan to pay off my mortgage in less than 10 years, right? And there's nothing wrong with paying off your mortgage early in your 30s or 40s. I'm not against paying off mortgage early at all. And I know someone who paid off his mortgage at the age of 38 and he doesn't regret it one bit. The only expenses I want to worry about are the property tax and homeowners insurance. The generational wealth I want to pass down is my real estate, 529 college savings plan, retirement plan, and most importantly, financial education to my kids and then future grandkids. I don't want to give them millions of dollars in wealth when I die without properly educating them on wealth management. It's like giving a lottery winner $100 million without having any financial knowledge, right? And don't wait until next year when you start filing your taxes to realize that you're gonna owe thousands of dollars to the IRS. This is pretty common for people who recently went through a divorce, own a business, or just simply not withholding enough federal income tax on their paychecks. You should look at your investments and make sure that you are on track to become financially independent and make early retirement a possibility. You can always reach out to me by visiting firesanchez.com/coaching to discuss your current financial situation or if you need help with financial planning.